welcome back to the trading desk. We started talking a little bit, Jesse and Dave. We started talking a little bit about the buying on the way down versus. I always preach, and Dave, we were talking about this in between the segments. Waiting, show me. The Missouri trade. Wait for a little bump to know when a bottom is. I guess my feeling is I've tried to catch that perfect bottom many times, whether it was a market, whether it was a stock, whether it was a future, and I've found that I may be right eventually, but I've taken 1,000 cuts on the way down, and by the time it gets back to where I'm, all right, I had to take all this pain for so long, and now I'm back to maybe break even, and I start peeling some off, and then it really goes without me, and I'm not even around for the ride.
You're not objective when it finally turns in
right,
your direction.
and again, I'm a trader. You're in it for the long haul. All these things, and
I
agree with you.
To make too is I'm not trying to catch bottoms. I'm trying to buy 50-cent dollars. So if it goes to 40 cents, 30 cents, whatever, I'll buy more. Whatever. I'm not trying to catch the exact bottom, but from a straight up investing discipline. You're basically just trying to buy cheap stocks, and you can get cheaper. And I think honestly the ideal is to try and marry both the philosophies.
I was just going to say that.
Find cheap stocks and use some kind of trader mentality to time your entries and that sort of thing.
I think that's the ideal.
And
mix.
that is what I do. I mean, I'm trading around positions too.
Of course.
So but.
And when you say trading around, why don't you talk to the audience a little bit about what that means? Because you may be buying, but when we rally a little bit, you take a little bit off so you can buy it higher or lower.
Exactly. I mean, if things are, going down, whatever, and, technically it looks like it's going to bounce, I'll add to it.
Sure.
Maybe average down a little bit. When it bounces, I'll take that off. Yeah. And it just helps, kind of.
Because I think all of us are in agreement that you can time the markets and you need to time the markets. We've talked about this excessively. Allocation, we do believe, is not the most appropriate response to being in a marketplace.
Well, traditional asset allocation will tell you need to have exposure to all assets at all times. And that's, in my view, asinine. I mean, you don't want to be in internet stocks at the top of the internet bubble. You didn't want to own real estate, though, over the last 2-3 years. There are times when you don't want to own an asset
This
class.
market environment proved once and for all that all asset classes can go down simultaneously.
Oh, exactly. And
even gold fell $100 in the last 4 days.
In the last 4 days, yeah.
So I mean that is exactly
it.
It
goes back to a trader's market. Whether you want to be a short-term trader or if you want to be a longer-term investor like Jesse, there are tactical allocations you have to make from time to time. But trader's market. We've been talking about that forever.
Listen, before I'm steamed. I came in here on CNBC this afternoon at the close of the market. They had Representative DeFazio from Portland. He's not in our district. We didn't even have a chance to vote on the guy. He's been a long-time politician. I challenge him to come on here and debate all three of us anytime, because listening to somebody talk about a trader's tax when the simple facts are markets are run by traders, period. Whether you're a mutual fund, hedge fund, or a trader.
They want to come in and they basically want to discourage short-term trading by making it unprofitable to do so.
They want to come in and tax 1/4% of every dollar traded in any marketplace.
The value of the trade.
The value, pure value. 1/4%.
So, for instance, on futures trades, like we were talking earlier, now you can get in and out, $2 in, $2 out, maybe even cheaper, maybe a little more expensive. Now we go to almost $50
$50 just each side. You're talking about a 25-fold increase.
And ultimately, that would reduce liquidity in the marketplace, which is ultimately a bad thing.
And you think the markets are bad now?
Yeah, liquidity is the key to any successful market.
Exactly. And you want to intervene, you'll see people walk away.
Somehow I don't think he has a background in economics.
I'm just guessing. Again, come on. We'll talk to his representatives. Please come on the show. We'll debate it, because I guarantee you no trader will go quietly with this one, because they will leave the U.S. markets.
They'll go outside the borders.
They'll go to China. They'll go to Australia. Anywhere else where they have free markets, because nobody will, in their right mind, if you believe in free markets, will put up with this legislation and this tax. And why are we going after these taxes? The beer tax, like you're talking about, Jesse.
The trader tax is probably the second most hated proposed tax. The beer tax, no way.
It's way more important.
Absolutely insane.
Oregonians are not going to let that happen.
Exactly. So stop taxing after the fact. Stop being reactive if you're in government, please. It's old. You guys need to be more proactive on the upside. When things are good, then ding some people a little bit, but don't do it now after people are down, and don't kick them when they're down.
It's amazing the number of fees that are being proposed at this point in time.
It's from the city all the way up to the national. It's throughout the system, and it's broken, and we've got to change that. When we come back to the trading desk, we're going to do another interview with a local professor here at the University of Oregon.